What if I told you that one small reporting mistake, something as simple as how you track a $300 weekend sports bet, could trigger an IRS audit and cost you thousands in back taxes and penalties? And what if I told you that high earners are currently sprinting toward a massive misunderstanding of the new $40,000 SALT deduction, assuming it's a free gift from the IRS when it's actually a strategic hurdle? Today, we're breaking down the mechanics of gambling income, the reality of the new SALT rules, and why even renters are leaving money on the table. A lot of people are getting this wrong because they're reading headlines instead of the tax code. We're fixing that right now. Welcome to the channel. I'm Stephen Lee, CPA and Certified Private Wealth Advisor. Each week, I take real financial questions so you can stop overpaying the government and start keeping more of what you earn. And before we dive in, if you have a question about your specific situation, drop it in the comments below. Quick reminder, this show is for educational purposes only, not specific tax, legal, or investment advice. I'm a CPA, but I'm not your CPA. And before the first question, I want to share a realization I had this morning. My alarm went off at 5 a.m., and by 6 a.m., I was in the gym with my 11-year-old son. For the first time, he actually wanted to work out with me, so I woke him up and we headed to the gym for the first time together. And as we started, my patience was high, trying to teach him how to do certain movements and exercises for the first time. But as we progressed, as you know, patience does wear thin. I had to shift my mindset. And as I looked at him, realized something. He didn't need a coach this morning, he needed a father. And he needed me to be encouraging, to be present, and to just be there with him, not just manage his performance or help him to get stronger. So one thing I wanted to do was I looked at my calendar, and for the rest of the week, I looked at it. It's packed with client calls, content filming, and pickleball. But from the outside, it might look like the calendar is really productive. But I had to ask myself, if I repeat this exact week every week for the next 5 years, where does it actually put me as a father? Am I getting closer to my son? Am I building the kind of man I want him to be? Or am I just busy? Here's the truth I realized. My calendar and your calendar, it's really a forecast of your future. It's easy to get lost in the busyness of life and forget to schedule the things that actually matter, like being an encouraging parent. If we don't intentionally protect that time, it gets swallowed up by everything else. And the reason we talk about strategy, whether in life or in finance, is to make sure our future self is actually standing where we want to be. All right, let's get into the first question. Question number one, I call it the $300 gambling trap. Our first question comes from Mr. Average 2000. Thank you again for the question. If I place two $100 bets, one loses $100 and the other wins and pays $300, do I report $300 or $200? This is the number one mistake recreational bettors make, especially now that sports betting apps are in everyone's pocket. Most people think logically, I started with $200, I ended with $300, so I made $100 profit. In a normal world, that's how it works. In the IRS world, absolutely not. The IRS does not allow net reporting for casual gamblers. You must report the full $300 as gross income on Schedule 1, Line 8B. That $100 loss, it doesn't just disappear, but it doesn't lower your income number on the front page. Here is why this costs people. You can only deduct that $100 loss if you itemize your deductions on Schedule A. If you take the standard deduction, which the vast majority of people do, you must report the $300 as taxable income, but you get zero deduction for the loss. You're essentially paying taxes on money that isn't even in your pocket anymore. Pro tip, documentation is your only defense. The IRS doesn't take your word for it. You need a log, including the date, the platform, and the amounts. These betting apps report winnings to the IRS via Form W-2G. If your numbers don't match theirs, you're triggering a mismatch notice and an automated bill. Report the gross or be prepared for the headache. Question two, the $40,000 SALT myth. Next, This question comes from @Jello Madison. Love the name. If I'm single and make $400,000, do I get the full $40,000 SALT deduction? The short answer is yes. For 2025, the SALT, that stands for state and local tax, cap has moved from $10,000 to $40,000 for single filers. But because it's the IRS, there is a hidden phase out. If your modified adjusted gross income, or MAGI, exceeds $500,000, that $40,000 cap starts to shrink. It's reduced by 30 cents for every dollar you earn over $500,000. However, it will never drop below a floor of $10,000. And since you're at $400,000, you are safely in the green zone. You qualify for the full $40,000 cap. But just because the cap is $40,000 doesn't mean you get a $40,000 deduction. This is an up to amount. And if you only pay $25,000 in state income and property taxes, your deduction is $25,000. It's a ceiling, not a floor. You still have to pay the taxes to get the deduction. Question 3, why renters should care about this SALT cap? This leads into our final question from @Maverick_3127. Their question was, what about people who don't own a house? Does SALT matter for us? This is a massive misconception. Many people think SALT is just a homeowner's perk. It isn't. The SALT deduction is actually an itemizer perk. If you are a high-earning renter in a state like California, New York, or Massachusetts, you are likely paying a significant amount in state income taxes. And what counts towards your SALT deduction? State income taxes or state sales tax, but you must choose one or the other. Personal property taxes are included. So those are the things that you have to take into consideration when you're looking at your SALT deduction. An example, let's say you rent an apartment, so you pay zero property tax, but you paid $35,000 in state income tax and $1,000 for your vehicle registration. Your total SALT deduction is $36,000 because the cap is 40. You can deduct the entire $36,000 as long as your total itemized deductions beat the standard deduction. And if you live in a state with no income tax, like Florida or Texas, you can choose to deduct sales tax instead, use the IRS tables, or keep your receipts for big ticket purchases like for vehicles or cars. The theme today is simple. The details determine the outcome. Whether it's how to report a $300 bet or how you view your time with your kids, being busy isn't the same as being strategic. And if this video cleared up a tax headache for you, or the 6 a.m. gym story resonated with you, hit that like button. It helps this channel reach more people who are trying to build a better future. And something to do right away. This is a little bit of homework for you. Look at your 2024 return. And if you took the standard deduction, but were close to the limit, this new $40,000 SALT cap might be your ticket to huge savings in 2025. And drop your questions below. I'll be in the comments answering as many as I can. Let's be strategic, be disciplined, and I'll see you next week.